Hello everyone, Daniel here from Infovest. Hope you're all doing well. I want to update you on a couple of interesting events in the market. So today we basically have been seeing equities, bonds, currencies, the gold all rallying, and the dollar basically plunging today. And the big highlight and the big news that caused this massive move up was coming out from the Bank of England. It was all about the UK today, all about the UK, and its gilts, UK gilts. So UK gilts, they're what that is they're basically bonds, long dated bonds, and these long dated bonds, their yields were basically moving higher, higher, and higher. And, the Bank of England, just like all other central banks out there, were going out into the markets, into the economy, increasing interest rates, and still are. They're still increasing interest rates. Just recently, we had the British pound completely collapse, completely sell off, had a big kind of flash crash, and then slowly went up on anticipation that the Bank of England is expected to do a 100 basis point rate hike or maybe even more. And when that happened, the markets were anticipating that the Bank of England was going to come out, intervene, and say something, just like how the Bank of Japan did as well. Now, the thing is, Bank of England came out today, early this morning, during the European session. They came out and said that they plan on basically buying UK gilts. So in other words, QE. And it's funny because tomorrow they were expected to talk about QT and talk about their plans of the balance sheet runoff. And they came out saying, going completely 360 and flipping, and saying that, hey, we're gonna buy UK gilts, which is AKQQE. Now, whether they call it QE or they may call it non-QE QE the same way, and it's funny because you heard something similar to this before, pre-COVID 2020, before the crash there, where the Fed came out and did non-QE QE, basically meaning that they're buying bonds, printing money, but hey, don't think it's QE. We're not pumping money into the system. Don't think it's QE. We're not increasing the balance sheet. It's just a technical thing that we have to do. And again, same thing with the Bank of England, non-QE QE, that hey, we have to do this because there's some issues and risks in the financial markets that we see, and yields are moving up too aggressively, and we have to just solve this little technical issue that's happening. And what is that issue? Why are they going out and they're buying UK gilts, right? You would think that, the British pound basically sold off, and in order to bring it back up, yes, increase interest rates, which does part of it, but stopping QT is not going to help the pound from dropping. That actually makes it sell off even more, right? So, if you wanted to fix that, go with the QT, not the QE, but they're going with QE, which is, again, printing of pounds to buy UK gilts, long-dated gilts and long-dated bonds. So, backstory, again, like I was saying, a lot of these central banks are coming out, printing money, a lot of these central banks are tightening by not printing money, raising rates, and continuing to raise rates, which is causing, yes, the short end to move up, but also the long end yields to move up. And as inflation continues to be higher and continue to be elevated, and there's a energy crisis and whatnot, is definitely causing yields to move up higher due to the inflation expectation in Europe and in UK. So now, why would the Bank of England come out today and say, okay, we're going to buy UK gilts all of a sudden? And they came out and they said that because there was a big issue that's happening with pension funds. And pension funds are about 1.5 trillion pounds in terms of the assets out there. And that makes up about two-thirds of UK's GDP, which is insane. Now, what is happening with this pension funds? What's going on? Now, 50% of those assets, that 1.5 trillion, which is two-thirds of UK GDP, are in UK gilts. 50% of them. And if 50% of them are in UK gilts and you're seeing the bonds sell off, which is good, which you would think is good because that means the yields are higher. Pension funds who are investing or want to buy bonds and want to return and want a higher yield, then great. This is like, paradise for them. But, however, it gets a little complex here, and I'll post a link that explains it better than how I'm going to explain it. I still have, sometimes difficulty reading through all of this, and it can get complex. But they have a certain, and I'll find the word here, just give me a second. It's called liability-driven investment, LDIs. So what they do is the liabilities that they have, they match it with the assets. And those assets are the UK gilts. So they try to match it so that, they don't end up owing so much, or, they can make some gains and also probably a risk side of it that, I guess in the article they go in saying that it doesn't really move too much with, or doesn't move at all with yields, but doesn't seem like that's true as of today. And it's a way to protect them, and they can hedge themselves with some derivatives that they have, and these derivatives that they have will probably soften the volatility and the fluctuations that the yields or the assets that they're investing in won't move so much, whether it's a corporate credit or equities or bonds or whatever. So it kind of softens that through the derivatives that they have. Now, to explain it in very simple words, is what's going wrong with the situation is these pension funds, right? The fact that a lot of these employers and that owe, and these pension funds that owe a lot of money to these employees and to these people, these pension funds are starting to show some signs of cracks. And those signs of cracks are basically them going out to the Bank of England and saying, hey, if your gilts go up any more higher, the yields on your gilts go up any more higher, we're going to go bust. Because a lot of these pension funds are, they need some sort of collateral, and that collateral are those assets, the UK gilts. And if those collateral, if that collateral out there, if they get basically margin called, which they are, then they need to sell and get rid of those gilts, which is one, yes, causing the yields to move up higher, but two, also making it less manageable for them, for their scheme that they've got going on with these LDIs. Now, and this started to happen way before this, and it started to just exacerbate now because a lot of pension funds are getting margin called and they're selling these bonds and causing the yields to move up, which other pension funds are seeing that, oh my gosh, okay, now they're also getting margin called. And if this is a trickle effect and it continues, it can cause pension funds, insurance companies, financial companies, institutions, the whole financial industry and market in the UK to go bust. There could be, a huge crisis that could be sparked in the UK, and that would probably also trickle into all other markets as well, because BlackRock and other companies out there are also invested and managed in these LDIs, right? So they are participating in that area too. And BlackRock being a huge company that manages trillions of dollars, and it makes you think why a couple of months ago I posted a video about BlackRock CEO selling a huge portion of his positions into the market, and he did the same thing back before 2020 came, the 2020 crash that we saw, the COVID crash that we saw from January to March, and he's done that already, right? So definitely he sees something that the market may not see. Now, in my yesterday's video, I talked about I don't know what's gonna break that's gonna cause the markets to completely plunge. Is it gonna be this scenario from the UK? Is it gonna be that a lot of these pension funds, and even in Europe, even in Germany, maybe, do they go bust, right? We see that the German UK yield curve, the 30 to 5 year, go into deep inversion levels that we've never seen before. Are we going to see, some situation come out from Europe and causing a catastrophe everywhere globally? Maybe, maybe not. I don't know. So leave a comment below. Let me know what you guys think. I'll leave these links here as well. A couple of links, interesting articles that explain this concept. And also a Twitter link there as well. And definitely this doesn't look good. And definitely if pension funds are getting margin called and blowing up, and I know this is just for the UK right now, but it does affect the markets as a whole. It will affect markets globally, because we live in a globalized world, and you do have other companies, especially in the US, like BlackRock, who are managing this or invested in this, and it can definitely be a trickle effect. And it kind of reminds me of like the 2008 scenario with the mortgage-backed securities, the MBS, that just completely went bust, and it just caused a trickle effect. Started in the US, caused a trickle effect in throughout the world. So if you're watching this video and you understand, if you want to comment on these products, or what I'm talking about here about the LDIs, you have a better way of explaining it, please do leave a comment below. We'd love to hear your views on this. And definitely this is a great follow-up video from my last video when I was talking about it's not looking good and it looks like pain is coming, and these are the signs of cracks that are showing up, and these cracks are the water starting to seep through these cracks, and eventually it looks like something's just going to break. I don't know what, but something. Anyways, I'll see you guys around. Thanks. Bye.